The Australian dollar rose 2.5 cents this week to touch 75 cents, a one-month high. There were two main factors driving the Aussie gains: the weak US jobs report and the Reserve Bank of Australia meeting. US jobs numbers were very disappointing, well below market expectations, with a rise of only 38,000 in non-farm payrolls in May. There were also downward revision to previous months. The US labour market is still quite strong overall, with the unemployment rate below 5%. But clearly the deceleration in job creation is a concern. Fed Chair Janet Yellen discussed the data this week, as well as retaining an overall optimistic outlook on the economy despite that concern. So she's still talking about raising interest rates in coming months. But clearly, the chances of a rate hike as soon as next week's meeting have fallen considerably, and in fact, markets are pricing a 0% probability of a rate hike in June. Pricing for a rate hike by July is only about a 20% chance. So clearly this has weighed on the US dollar and boosted the Aussie. The Australian dollar also rallied after the Reserve Bank of Australia meeting. The RBA kept the cash rate at 1.75% as fully expected. However, there was a bit of a surprise in the statement. There was no clear hint that the RBA is considering another rate cut, which is what most in the market have been expecting. The statement strongly suggests that there's very little chance of another rate cut in July. But Westpac is sticking to its call for a rate cut at the August meeting, after which we will have seen the second quarter CPI numbers in late July. Such a prospect is about 50-50 in terms of market pricing. But the Australian dollar struggled to remain above 75 cents as the week wore on, with global risk aversion starting to rise once more. There was also a rate cut from the Bank of Korea that was very unexpected and hints at weakness in Asian economies. Meanwhile, the Aussie dollar fell steeply against the New Zealand dollar, which had an extremely strong week, particularly after the Reserve Bank of New Zealand kept its cash rate at 2.25% and indicated that it wasn't in any great hurry to cut the cash rate again. The Aussie-Kiwi cross is now around 104, which is the lowest in about 13 months. Westpac does expect the Reserve Bank of New Zealand to cut its cash rate again to 2%, probably at its August meeting. So that'll take a little bit of heat out of the Kiwi. But near term, the Aussie-Kiwi cross does look very soft and may yet slip towards the 103 level before heading higher. In the week ahead, the main focus for the global markets is on the Federal Reserve's FOMC meeting. While market pricing is 0% for an actual rate hike, there's always lots of interest in their commentary around the economy and their projections of where interest rates may go in coming years. In Australia, the main focus will be the May employment numbers out on Thursday. Westpac is looking for a decent rise of about 17,000 in the month, with the unemployment rate holding at a quite low 5.7%. This should be supportive for the Australian dollar in the week ahead, helping it stabilise, finding some support on dips and carving out a range of mostly 73.50 to 75.50. We'll speak to you next week.